Good afternoon. My name is Aaron Jacobson Swanson, and I'm the president of CFA Society Atlanta. I'd like to thank you all for joining us for our 17th annual forecast event. I would like to extend a special thanks to our sponsors, Voya Investment Management, T. Rowe Price, and Wells Fargo Asset Management. This has been a challenging year for all of us, with significant impacts on our families, communities, and businesses, and our CFA Society is no exception. I'm proud of the work of our society's volunteers and leaders in overcoming these challenges, from successfully transitioning to virtual programs to rolling out new initiatives like our first ever ethics challenge. I also believe our society will continue to benefit from many of these technological advances, even after we are all able to get back together again. Our panel this afternoon features 4 distinguished panelists from top investment management firms and is moderated by a senior wealth management executive from a top RIA firm. We also hope you will join us for our 2 upcoming virtual events. On February 20th, from 10 a.m. to 1 p.m., we'll have our 13th annual Research Challenge Southern Classic, with teams representing colleges and universities from Georgia, Alabama, and South Carolina, where students will be tested on their analytical, valuation, report writing, and presentation skills in the assessment of this year's subject company, Aflac. Additionally, on February 25th, from 3 to 5 p.m., we'll have our Black History Month highlight showcasing a distinguished panel of finance professionals from the African American community. Finally, CFA Society Atlanta is one of the few societies in the country with the benefit of a partner foundation, the ASFIP Foundation. Through our fiscal and volunteer support of the ASFIP Foundation, CFA Society Atlanta is able to leverage our collective resources and expertise to promote financial literacy in our community and the world. With that, it is now my pleasure to introduce the president of the ASFIP Foundation, Jackie Cushman.
Thank you, Aaron. I really appreciate it. Our mission at the Foundation is to promote the economic stability of young adults in our community by providing foundational knowledge and financial literacy. Our partnership with the CFA Atlanta is really important. You see, our strategic vision is that we develop financially confident and curious young adults to make sound financial decisions by harnessing the power of our uniquely qualified volunteers, that's y'all, to deliver educational programs and to partner with mission-aligned nonprofits. Part of what we do really is we make sure that we have volunteer opportunities for you, but more importantly, we also look to you to bring us programs that we can provide. So please, if you have any program or if you have some time you'd like to give to us, or of course, we're always willing to take donations, please contact Kathy Ford and she will forward your information to me. But our partnership with CFA Atlanta is so incredibly important. Today, normally I would have someone from Girls Inc. here on stage with me if we were together in person, and I don't. But what I'm going to do is I'm going to present to them, virtually of course, a check. And the reason it's really important that we provide this is we not only provide the services, we actually go to Girls Inc. and actually give and help and volunteer with them, but in addition to that, we provide money for them. So this year, we've donated $3,500 to Girls Inc. They serve over 500 girls in the Atlanta area. And as part of our programs, we go, and now it's virtually, of course, but we spend time with these girls and make sure they understand the importance about financial literacy. So thank you so much for your support. We could not do it without you. And again, if you have any ideas for programs or would like to volunteer, please let Kathy Ford know. We'd love to have you come join us. Aaron, back to you.
Thank you, Jackie. I would now like to introduce today's moderator, Heather Fortner. Heather Fortner is the Chief Executive Officer of Signature FD. Having previously served as a Chief Operating Officer, Chief Compliance Officer, and President of Signature FD, Heather's learned, navigated, and held strategic oversight of every aspect of the organization. She's also a highly sought-after leader in the industry and is regularly asked to speak on the ever-changing landscape of wealth management. Without further delay, I give you Heather Fortner.
Thank you, Aaron. I want everyone to know that it is a very big privilege for me to be here today and to share this virtual stage with such a distinguished and accomplished panel. Before we get started, there are a couple people that I would like to thank. First and foremost, Kathy Ford, the executive director of this society. She has done a fantastic job allowing this society to continue to meet together virtually and to have the vision for this organization to continue to come together in just such challenging times. So thank you, Kathy, and thank you for the opportunity to be here. To Chris Wilson, he's a senior client portfolio manager at Voya. He's been a stalwart for me getting prepped for this presentation. He is actually going to be monitoring our Q&A. So as you engage and as you go through, we go through the session, if you have questions or anything, just go ahead and put them in the chat, and Chris is going to get those over to us so that we can answer them for you. To our panelists, y'all have leaned in and spent time with me for months now preparing for this panel, and I just wanted to say thank you to each of you. To my friends at Signature FD, the investment team, they really helped prep for this event. What helped me figure out what in the world this audience would want to hear about and talk about. And so I really wanted to just thank them for the time that they put in to helping prepare for this discussion. But more so, I wanted to thank them for the diligence and the excellence that they bring to the table for our clients. And when I started thinking about that, I started thinking about you in the audience. And I hate doing events virtually because I can't see you, but I did want you to know that there is a true admiration and appreciation for the effort and the excellence with which you hone your craft. It is extraordinary what you do. And I think that if we were to collectively look at the amount of wealth and dollars that our audience, the people in our audience affect and make decisions on, that it would be not only billions of dollars of wealth, but it would be millions of people's lives. And at Signature FD, one of the things that we believe is that there is real power in wealth when it's used to support the things that matter most to the individual. And we call that net worthwhile. And I just want you to know that I truly believe that your expertise and the expertise of the people on this panel, it's what helps make net worthwhile possible for others who then are able to change the world with the wealth that you help create and manage. So it was imperative for me that as I prepped for this event, that we created the space for there to be quality dialogue, for us to cover the areas that we felt as a group were going to be of priority to you, but that also that we were flexible enough to go where you wanted to go when you wanted to go there. So please do use the chat and send those questions in as you have them, and we'll get to them as quickly as we possibly can. What we're going to cover today, I'm just going to give you a brief overview of where we're headed, and then I'm going to introduce our panelists, and we're going to get down to business. We are going to start globally. We're going to start in China. We're going to talk about Asia and Europe. Then we're going to bring it home to the US, and we're going to focus on growth and the GDP. We're going to shift to administration, the new administration, and what potential effects that might have on the US and the GDP. We're going to talk about the more collaborative environment between the Fed and the Treasury, and we're going to talk about what implications that might have on debt markets and inflation. We are going to lean into the discussion around the fate of the 60-40. We're going to talk about innovation in the industry, and then we are going to wrap it up at the end with whether or not we are in a bubble and should we be buying Bitcoin. I can't wait to do a lightning round with these guys at the end. They're laughing at me in the background. So without further ado, let me go ahead and get these guys introduced. Matt Toms, he is the Chief Investment Officer, Fixed Income for Voya Investment Management. Thank you, Matt. Brian Jacobson, he is the Senior Investment Strategist for Multi-Asset Solutions at Wells Fargo Asset Management. Thank you, Brian. Sami Muadi, he is the Emerging Market Fixed Income Portfolio Manager at T. Rowe Price. Thank you, Sami. And Degas Wright, he is the Chief Investment Officer, the Chief Executive Officer, and a Portfolio Manager at Decatur Capital Management. And I'm sure those of you sitting in the audience, I kind of feel like I'm sitting with a panel of of rock stars up here, because in the back green room they're talking about when they're going on CNBC and MSN, and so we have just a real panel of experts and quite honestly celebrities here. So I'm really excited to get started. So we are going to first start off with a 2-minute consensus outlook for 2021. Brian, you are on deck. Take it away, sir.
Oh, thanks. Yeah, and I think Degas is really the rock star, the real celebrity. So he's always enjoyable to watch on television. So at Wells Fargo Asset Management, I think that our consensus view, we have multi-boutiques, different teams and all that, kind of the general consensus across the firm is that 2021 is basically a year of like a do-over, right? If you think about what were the conditions going into 2020, there was the détente between the US and China on the trade war, and there was this real optimism about synchronized global growth. And people were a little concerned about valuations at that point. People are also concerned about, our policymakers out of tools in their toolbox, given what deficit spending was like, given where interest rates were. And then all of a sudden, wham, here's a coronavirus crisis to deal with. And that really, kind of changed the whole playbook as far as the way that people were investing in the whole growth outlook. Now, one thing that I think it did kind of teach us is that when it comes to fiscal policy or monetary policy, there are never really out of tools, right? They can always get creative. And it's that backdrop again with that big fiscal and monetary stimulus that we're probably going to be experiencing some of that tail now, as far as that additional growth impetus from maybe more fiscal spending in the United States. Now, we do have the year of a do-over as far as that synchronized global growth, but emerging from this coronavirus crisis. Now, also lower interest rates, expanding balance sheets of central banks, expanding budget deficits. And so people are wondering once again, are valuations a little bit too high? Fiscal policy, maybe is it a little bit too hot? From our perspective, maybe that's a 2022 concern. So when you're navigating 2021, expectations, if you look at surveys of economists, not that economists are necessarily the best forecasters in the world, but what else are you going to do? That really the consensus is calling for a rebound, but not really a sustained rebound. And I think that's where our team's view differs, is that we think that some of the structural changes that took place as a result of the coronavirus crisis could actually lift the steady state growth rate for the US economy and for developed markets in general, right? One of the big stories about the last expansion was that it was slow, but thankfully it was pretty steady, right? The Sharpe ratio of GDP was actually incredibly high. And maybe we're going to have a slightly higher Sharpe ratio for GDP for this part of the economic expansion. So we're still relatively optimistic despite where things are as far as with valuations and the such.
Wonderful. Thank you. Sammy?
Great. Thank you, Heather and Brian. So 2020 was about crisis and recovery. 2021 is the beginning of a path that we're all on, and it's going to be a period of financial repression. That sounds like a very ominous word. Forgive me, I'm an emerging markets person, so this is where it comes from. But it's defined as deliberate interest rate policy predicated on negative real interest rates. And you all see it in your CD rates and your checking accounts. The nominal rates are below inflation. The Fed average inflation targeting is really the beginning of that path, and it's a marked shift in the monetary policy framework for the United States. It feels like a negative comment, but I would actually say from a clinical diagnosis, it's needed. Focusing on the pandemic, but kind of given the debt dynamics in the developed world, that's really more what I think this is tied to long-term, not the pandemic, but just the amount of debt in the developed world. Deflation is the worst outcome for the architecture of our financial system. And longer term, there are only two ways to deleverage a sovereign nation. One is just fiscal prudence, so you run a primary balance. The other is the nominal growth of the economy has to exceed the interest rate paid on debt. And the nominal growth of the economy is the real productivity growth plus the inflation. And if I could offer you 200 years of financial markets history in about 20 seconds, we are nearing the apex of the third great debt cycle in financial markets history. In the mid-1800s, after the Civil War and the Napoleonic War, debt peaked. we went through an incredible period of fiscal prudence. The UK actually ran primary surpluses for almost a century. That takes us into the mid 1900s, the two world wars. Again, a peak in debt. But what got us out of that debt crisis was some fiscal consolidation, but a real growth and productivity boom, and then ended with some inflation in the 70s. So looking forward, let's take those tools that you could have to deleverage a sovereign nation. With the political realities in the developed world, there's no way we're going to be running primary balances for a long period of time. If anything, we'll be on the other side of that more with a deficit posture. Nominal growth is limited just by debt and demographics. It's hard to see the same productivity boom that we saw in the 50s and 60s. So inflation is really a little bit of the way out. And this kind of financial repressive policy, I hope to expand upon it on this panel. I hope to kind of give you some tools about what to do with that, especially with your fixed income allocation, and then dig into a little bit more detail, this inflationary push and pull. On one side, you have kind of the monetary impact and deglobalization, which are inflationary. And the other side, you have technology, Moore's law, and demographics, which are all deflationary. And I think that's something hopefully the four of us can help flesh out for the group attending today.
Wonderful, thank you. Matt, he went straight to inflation. So how about you go ahead and offer your outlook there?
Yeah, fantastic. I thought Sammy for a second was going to say fiscal prudence was the way forward, and I thought it was going to get really interesting because I'm not sure which party really represents that now. But I think don't disagree at all with the framing that Brian and Sammy offered. I think when we look at 2021 a little more narrowly, a lot depends on the near term for COVID, and the right way to play COVID has been believe human ingenuity and the immune system will win faster than expectations, and we continue to believe that. So even disappointment about vaccine rollouts, I think will turn into surprises about speed and availability around the world. So we'd say one, take the over on human ingenuity and vaccines. That should drive an over on growth, which is being priced into a good amount of the markets, but not all markets yet, particularly debt markets. That means risk assets should generally have a really nice footing, and we've seen that it's been pulled forward. But risk asset pricing, a lot of people like to say, where were we pre-COVID? The financial conditions as laid out by Sammy mean they should be higher, right? So all assets really should be worth even more. And you've got some fiscal and monetary policy to help that along through the year. So it paints a very, very positive picture. The one big variant that we need to watch, because that's all I think baked into most consensus forecasts, is what does inflation do? And inflation expectations have moved up quite meaningfully, but they moved up more in the US than the world. So it's unlikely, in our opinion, to see US inflation without global inflation. We think the delineation between cyclical inflation and structural becomes so critically important. So cyclical, yes, we look at the 2-year inflation break-even assumption, it's about 2.5%. The 10-year is actually 2.2%. So a bit of a pig in the python. You've got a lump of inflation coming through. Does it persist is the bet. And that's the most important thing for financial markets this year. We think you will see a structural inflation expectation increase. The bet on, is it long-term or not? Certainly cyclical, we don't know. I'd throw out one more important example there is the vaccines themselves are viewed as the ability to re-engage and create inflation, but the vaccines themselves represent what an incredibly productive world we live in, as Sammy alluded to. Global productivity has created vaccines 4, 5, 6 times now that didn't exist a year ago, and they're going to cost very little, and they're going to cover the entire world. That's what you're betting for if you believe in structural inflation. So yes, short term, long term, there's a big push lower. It's about, is it basing from a multi-decade standpoint? So look forward to driving into that a little bit more through the panel.
Thank you, Matt. All right, Digas, bring us home.
Well, okay, so now Heather, now this is a tough job because following this route. So I'm going to try. So what I'll see the 2021, and everyone's really set it up really well because 2020 was a period of immense disruption. And so as we get into 2021, there's 3 things that I like to focus on. One, vaccine. Matt, you set it up really well. The vaccine is working. If you look at the 7-day delta, which looks at the number of cases over the last 7 days, that has been declining for the last 30 days. So we're starting to do that rollover in the vaccine, and that's key for reopening. The next thing, you look at the overall general markets, and I'll focus on the US for this discussion, if you look at the S&P 500, you have approximately 80% of those companies surprised in earnings on the upside, the median around 12%. Earnings surprise. The second thing, and this is what I really like, revenue were surprises. And revenue surprises, another 80% of the companies I reported to date have basically reported a 7% surprise. That means revenues over the expectations. So the earnings story is very positive for this market going forward. The last thing is profit margins will continue to improve. The 2020 allowed companies to actually reduce expenses. Almost every company in the S&P 500 went through and looked at expenses and started to reduce. There's a paper packaging company, their executives actually took a 25% pay cut, both their senior management and also their board of directors. In addition, their SG&A was reduced about 6%. That company is doing exceptionally well now because revenues did not fall off as deeply as they thought. So if you look at those three aspects, the vaccine is working, the earnings surprises and revenue surprises, and then you come back around to profit margin improvement, we're seeing that this market will go up. Now, how far? I will be bold enough to say that right now we're at about 3,900. We're going to forecast at least a level of about 4,300, which is another 10% gain. And so we feel pretty confident about getting there. And there may be a pullback as we saw last week. But we feel that this market, given those things I talked about, will be on the upside to another 10% from here.
Wow, that's fantastic. Thank you. Okay, we're going to go big. We're going to go global. Sammy, we're going to start with you. We want to know, China is in the news. And quite honestly, they've been in the news for pretty continuously for the last year with the coronavirus and everything starting there and what happened. And I know the WHO is there now. Can China and the US both exist as global superpowers? And what does that look like for us?
Yeah, so I think China is an appropriate place to start. A year ago, the last time I was actually on a plane was literally to Atlanta about a year ago this time. And I remember being at the airport and chatting with people that I was sitting with, are we actually going to be on a plane again this year? Because here we are a year later. So let me start with COVID and then kind of expand upon that. So on COVID, just for context, my Hong Kong and Singapore based colleagues are already back in the office together.
Wow.
My colleague in Baltimore is my 4-year-old who colors The Little Mermaid while I'm on the Bloomberg terminal. And they can't even book a table for lunch because the tables are taken in Singapore. So I think that Asia has kind of shown us, or some countries in Asia have shown us that there is a way to manage around this. It's actually exciting for me to see them going to work, albeit a moment of jealousy. They were first in, first out of COVID, and I think maybe give us a template for what's on the other side of this. But while there's a tendency to focus on the headlines in Asia, I would really focus on the returns. If you had told me a trade war started 3-4 years ago, I would have thought that would beat up the Asia markets. And actually, if you look at the global landscape, Asia credit has been one of the top performing asset classes, which I think surprises a lot of people, but is actually very true. Just for context, I own a company, a Chinese high yield company that makes diapers and baby formula. Being the parent of a young one, I can assure you that is a recession-proof business. No matter what is tweeted out, no matter what sanction or tariff comes in, diapers and baby formula get sold in China. So it's a huge market. I think it's often narrated kind of through a narrow lens, but when you look at the depth of companies within that, it's actually evidenced in returns that you should not be paying too much attention to the headlines. And for me, it's fitting. I actually, funny fact, don't read a newspaper and have not for years. It's liberating. It's nothing against journalists. It just doesn't fit my utility function as an investor. I start with data. I read a bunch of T. Rowe Price research, read a lot of books. So there's no shortage of information you can consume. But I think reading the headlines maybe steers you away to something that's not conducive with generating returns in the market. So what I would guide you looking forward in terms of what to follow, the short answer is yes, China and the US must coexist. But in order of importance, what you should focus on is first trade very narrowly. Second, more important would be technology. Third, more important would be capital flows, the capital flow from China to the US and back. And lastly, most importantly, this is really the 100-year war here, is reserve currency status. That's what China is aiming for. That's what the US has, the exorbitant privilege of being able to run a $500 billion current account deficit, export paper to the world, and import everything else. That's what One Belt, One Road is about. That's what the US is trying to prevent from happening, because it's the only nation that has that exorbitant privilege. So I think these second two topics are the ones that have popped up recently. You've seen sanctions on companies trying to prevent capital flow. We saw the issue with the anti-PO. And now eventually that's going to move into the reserve currency realm. And we're going to see an escalation. But I think at the end of the day, China and the US need to coexist, because this is a world, and certainly a financial markets architecture, that needs stimulus. And for as much as the Fed has done, China has done literally 10x since the global financial crisis in nominal terms. So I think they need to coexist by mutually assured destruction.
Talk to us about Asia, more about what you see happening in Asia, especially in relation to China right now.
Yep. So, so China is past its peak stimulus. So they provided a big bout of stimulus last year, as everyone did, but they're actually the first to start tightening. And you see it reflected in Chinese interest rates. You see it reflected in the delta in Chinese policy. The US is looking at passing another package while China has stopped. They've kind of reached the apex of what their development model is built on, the Japanese development model in post-World War II. And they're akin to kind of where Japan was in the late 80s and 90s. And it's actually a pretty good thing for the debt market. We may debate the impact on equities, but there will be a necessary deleveraging that China needs to go through. You're starting to see some early signs of it that actually began in 2017. So you'll see the US trying to press stimulus a little more, while China needs to take a step back, just because the arithmetic of how much stimulus that they've already done is getting in the way of its efficacy. I think that's a bullish argument for credit. That's a great environment. Deleveraging is a very good thing for credit, but I think maybe should tread with a little bit of caution in terms of what type of equity exposure we're running.
Wonderful. Thank you. Matt, take us to Europe. Talk to us about, there's been some, they're fairly still shut down, and they're having trouble getting their COVID vaccines out there. Is that going to affect their ability to get their economies back?
Yeah, I think it's an incredibly important topic. And as US investors, we can often mistake that we're part of a global system. And so Asia emerging more quickly in China is important. And that will ultimately help pull Europe. But let me come back around to that and start at the top of the question. You know, Europe has never been known to be particularly fast at a lot of things other than making really good sedans. And they're not being fast with the rollout. The coordination of the purchasing of vaccines has been mishandled. That's going to slow their implementation. It's going to slow the reemergence of a broader consumer economy, and that's bad news. There's another thing that a lot of people don't talk about. It's also the fiscal side. It's amazingly positive that you had a couple acts that look like joint fiscal policy in Europe. That is one of the big accomplishments of 2020, if you can put a silver lining around that cloud. But it's still relatively small and slow compared to US fiscal. So the speed of exit of the US economy relative to Europe for those 2 points, and the fiscal is really important, it is going to be faster and sooner. And I think you're seeing that in the dollar. You've had a real bout of dollar weakness, and then you've had more of a basing of the dollar recently, as suddenly the US looks like the odds-on favorite to growth because of the speed of deployment of both fiscal, lots of money being spent in last and current administration, and the vaccine. So I think those are important things. But I think the other thing that will pull this out, so it's subdued for Europe in the near term. Ultimately, European growth is driven by global trade quite a bit. Think of the German economy. It's still global manufacturing and export into China. If you want to oversimplify, make the machines and produce the machines out of the Far East, that machine really helps Europe. So as the world re-engages and as EM grows, you're going to have a subtle pull on Europe, not a push from Europe. And so I think in the second half of the year, that can surprise the markets at the degree to which the EM trade, which, oh, by the way, EM has naturally higher growth rates than the developed world. And there's a whole lot of debt in the world. So that's a good thing. The naturally higher growth rate is going to matter with the world awash in debt. Well, that higher EM growth rate tends to correlate with European growth rates. So that'll be the surprise later in the year. But one of the other surprises later in the year, I think, will be that people will start to look at China different as it relates to the world, and that China's been an exporter of disinflation for the last decade plus. And some of that's been a real benefit to Europe. Watch for the change in consumption behaviors out of China to start to matter. China is slowly moving to more of a consumption society. That can actually be a demand pull for different finished goods from Europe and from the US, or less exports. So that dynamic is changing. There's a new China coming. It's always kind of been an old Europe, but it's a new China.
That's awesome. Thank you. It's kind of like you've got some really fast cars in some areas and some slower sedans in other areas. Digas, bring us to the US. What are we driving, and how are the other cars on the road making us feel right now?
Well, no, thanks, Heather. And to Matt's point, one of the things that may hold back the global economy, Asia, Europe, and US, is the wealth gap. And so that wealth gap is really having an impact. And Jay Powell, Federal Reserve Chair, talked about this in that he feels that the wealth gap, the income inequality that's occurring in the United States, will slow down economic development. Now, and it's even more prevalent when we talk globally. The International Monetary Fund did a study, and they looked at if you increase by 1% the low income group, and that's the bottom 20%, this is globally, you end up increasing that country's gross domestic product over a 5-year period by 38 bips. And that's for that the bottom 20 percentile. Now, if you add 1% to the top percentile, high income earners, what occurs is that you actually reduce GDP by 8 bips, which means that the top earners are not really going to spend an additional 1%. Case in point, if a high wage earner gets $1,000 stimulus check, I don't think they're going to go out and spend it. It'll probably go into their checking account, savings account, or even into their Reddit Robinhood account. Whereas if you do the same thing for a low income individual, those dollars will be put into consumption. And through consumption, we have economic growth. And so that's why that 1%, if we can close the gap, the wealth gap, that actually could spur additional economic development, not only in the United States, but globally. And then we look at, where can we have the most investment? And it's something referred to as human capital accumulation. And that's really just talking about education and training. So if we could focus those dollars, that 1% I talked about, into that human capital accumulation, that could have an impact of closing the wealth gap. And one of the things I would like to share is that each person watching this video, watching this discussion, they can have an impact, because you can reach out to a student through a mentorship program. You can, if you are a leader in your firm, you could do a intern program, because that increases the human capital accumulation that can close the wealth gap. So the global economy will recover, but it's how fast that recovery will be and how deep that recovery going forward. And so this wealth gap is a global problem.
I love that. Thank you. Right now, minimum wage, the raise in minimum wage, potential raise in that is on the table. And Brian, as we swing into a new administration, there's obviously different policies, right? Different focuses. So talk a little bit about the new administration being focused on things like that. Minimum wage. How do we start to change this?
Sure. Yeah, it'll be interesting to see exactly what can be done. I think that they're going to try to really get as much crammed into a reconciliation bill as possible. And the rest of it, let's face it, it's a razor thin majority that they do have. And so really reconciliation or bipartisanship, those are the only two solutions. Bipartisanship kind of seems a little dead. And so a lot of it will likely go through reconciliations. And it's unknown as to whether or not, a wage minimum wage hike could actually help, especially after the CBO's report, which showed that 900,000 individuals could get raises, but 1.4 million people could lose their jobs, right? So I'm not sure if that arithmetic really adds up too much, especially as far as would be all that helpful in closing that wealth gap. As Diga's pointed out, investment in human capital with education, with health, that helps. And the IMF, they've done reports, right? It's such a complicated problem that there aren't simple solutions. Countries that have more redistributive programs typically have higher levels of income inequality, right? So what's the cause and the effect here? And one of the solutions that they have seen, and I think that Chair Powell really shared with this, is if you have an inclusive growth environment, so a long duration economic expansion that's inclusive. That's not exactly what we had with the last economic expansion. If you think about, let's say, the trade war, it hammered the manufacturing sector, right? Services did pretty well, manufacturing did not. And so you did have winners and losers throughout that economic expansion, despite it being of a long duration. So if it can be of a longer duration and of more inclusive quality, then that could be, kind of solve a lot of ills. And maybe to kind of put a thread through the pearls that Sammy, Matt, and Digas had shared at the beginning and throughout, we actually think that we could be set up for that longer duration type of more inclusive economic cycle here. Sammy talked about the debt cycle, right? A lot of companies, a lot of countries have taken on a lot of debt. Well, that's financial leverage. And if you remember from some of the basics of valuations and that financial leverage, that can increase your beta. Digas gave a good example of companies that's been going through increasing their operating leverage, right? Cutting costs, but now that revenues are surprising to the upside, you're seeing that really that operating leverage. So you combine the two, operating leverage with the financial leverage, that means that corporate profits are likely to surprise more to the upside if we do have some sustained economic growth here. And then kind of tying in what Matt was talking about as far as with inflation, right? Is some of the increase that we're about to see, is it short term? Is it sort of just, are you going to see a dip and then is it going to go up? Anybody's guess is as good as mine, but I think that what it means is the Fed is going to just dismiss it as being transitory. Chair Powell has pretty much said as much, that, look, prepare yourselves for these year-on-year comparisons to be pretty unfavorable. We had outright deflation in March, April, and May of last year. So kind of ignore that. And if the Fed is going to ignore it, that means that it's going to be, as Sammy talked about, the financial repression. We're going to keep rates low, even if inflation does begin to accelerate. So, accommodative monetary policy, higher operating leverage, higher financial leverage. Yeah, there's more risk, right? That's the double-edged sword of leverage. But we think that the risks are more to the upside as far as with the earnings per share surprises.
Thank you. Sammy, I do want to come back at one point to what you were talking about of the apex, right, of that leverage and knowing where that is. Why don't we go ahead and talk about that right now, Sammy? It's one question that I've heard over and over again is, when is the piper going to come? Like, how much of this debt can we actually take before, we can kick the can and our kids can pay for it, but how do you know when you really are reaching that apex and when other decisions are going to have to be made?
Yeah, so let me tie this into the concept of MMT, which has been proposed as sort of the answer here. And I take pause with the premise of the term MMT. So modern monetary theory, number one, it's not modern. I can go back to the Romans debasing silver from coinage if you want. Number two, it's not monetary, it's actually fiscal. And number three, it's not theory. I have dozens of case studies from emerging markets that I'm happy to go through.
So what should we call it, Sammy, if it's not MMT?
Is there a happy hour after this? I'll think of something. So there is a true underlying principle here, and I don't mean to discredit the great academic work that many people have done here. There is a true underlying principle that market access is not determined by the level of debt. So to your point, it's tough to pin down a number. You can sustain debt as long as you can access markets. Japan is solvent with debt to GDP of 300%. In my industry, I've seen Ukraine in the 2000s and Mexico in the 90s go bust with debt to GDP of 30%. And reserve currency nations are afforded the luxury of monetary independence that not everyone has. But I think to take this too far requires a very dangerous level of coordination between fiscal and monetary policy. And when you read the theory, and I would encourage folks to read the literature on this, when fully implemented, MMT requires Congress to play an active and permanent role in stabilizing inflation. Let me say that again. Congress is the one that needs to play an active and permanent role in stabilizing inflation. I don't think Congress could pass a bipartisan bill on whether to get chicken salad or tuna salad for lunch. So I don't want them in charge of inflation.
Right.
But this separation of church and state, it requires some necessary coordination, but you don't want to take it too far. And I do think the US actually handles this very well. For as much criticism as the Fed gets, we handle it better than most countries. It is the Fed is an amazing bedrock of American institutional strength. I think that's unlikely to change. This, for me, is probably more an issue in developing countries that don't have those institutional guardrails, where a QE-like program could quickly be corrupted into just outright fiscal dominance. So, all respect to the Fed and former Chair Yellen, I think probably respects this more than anyone who's held her Treasury role before. So they're doing a tremendous service to the American people, and I think kind of keeping that separation of church and state is quite important. But for now, we do need fiscal, and I'm going to make a dangerous analogy here, knowing this audience, but the U.S. economy risks being like the Atlanta Falcons in the fourth quarter of a football game. So you do not want to blow it and not pass this last fiscal bill when we're still in the middle of the pandemic. Victory is in sight. Let us not snatch defeat from the jaws of victory.
I literally just felt the collective breath just go out of all of the Falcons.
So, yeah, Heather, if I can interject on that, I love that analogy. That's brilliant. And Sammy, thank you for that history on it too, because I agree. So I might not like all the details of the current proposed stimulus. Maybe it goes from being economic relief to stimulus as far as direct checks to households that are making too much money, right? Unemployment benefits, right? I mean, there's so much in there that it's probably, all right, got to take, it's like a Happy Meal, right? You kind of have to get the fries if you want the burger as well. And so that's the way a lot of legislation is. It's designed as a Happy Meal. But when it comes to the MMT, I agree. It's a political expedient more than a monetary theory. And it reminds me of the Triffin dilemma identified back in the 1960s, as far as when we were in the Bretton Woods system with the dollar convertible into gold. The French eventually called our bluff because they realized that we had issued more greenbacks than what we had gold backing it. And the Triffin dilemma applied to the it was about 15 years early as far as predicting the breakdown of the Bretton Woods system. And I think that, Sammy, you did a good job of identifying, will it be an issue for developed countries like the US or Japan? Probably not, mainly because what would require have people have a crisis of confidence in the US to be able to issue debt? It would be, going back to the writings of Adam Smith, he talked about it's when you have too much inflation. So if Congress was in charge of it, that would be a problem, right? But if it's an independent central bank, or at least somewhat insulated central bank like the Federal Reserve, really it shouldn't be much of a problem. It's when you end up kind of crossing that line where it's the Congress or fiscal policymakers that are in charge of inflation, that's where you could get the crisis of confidence. So I don't see it being a problem in the US in the foreseeable future.
Does anyone see a problem with, maybe Matt, you can talk a little bit about this, with the more collaborative environment between the Fed and the Treasury. And you got two friends in there now, which typically that's kind of not the case. And that there has been this overabundance of support for the economy and money and liquidity into the economy. Will the markets be able to step away and take their foot off the accelerator there? And the Fed, will we be okay with that? Will the markets respond appropriately to that?
I think that it's an incredibly important question because you've got the convergence of multiple factors as laid out by both Sammy and Brian. The reality is that there is the difference between recovery and stimulus, and part of the next $1 trillion to $2 trillion is going to cross that line. The market will be more critical of stimulus than recovery funds. Because the global economic outlook looks like it has juice coming from the re-engagement. And I think this is a critical line where the markets for the first time saw $1.9 trillion whittled down to how much you really need, 800 billion? What will 1.3 do it? And they rallied. It's the first time during the COVID crisis where it's been the market's okay with less. That is a really important market sign to where it sees enough growth to not need extra juicing. So one of there's an important distinction between those two things. The other really important distinction longer term is that high debt levels, while sustainable today, tend to correlate with lower long-term growth. And so Japan has been able to issue tons of growth. What's their growth rate? Well, growth rates are ultimately defined by what you do with the debt, i.e., what's your productive capacity? How many people do you have and how productive are they? So what the US and what the developed world needs to do once you move out of recovery is to invest. And I think this is missed in financial markets. So the short answer is yes, you can run fiscal deficits for a time. I don't believe the markets will be supportive of that if it is towards increased social entitlement to the extreme. What the markets will want is, what is the other side of the balance sheet? Is it better infrastructure? There's something worthwhile there. You can issue debt at a negative real yield right now as the US government. And there's very few alternatives for reserve currencies. Where do you want to go? You don't like the US? Tell me the next best option, and you'll also tell me why you don't like it as much, right? So you've got this perfect storm. You can issue debt below real yield costs, do something productive with it, and that's going to actually create a very virtuous cycle of growth. Now, the one reason that I think we should be excited about this is that the Fed is talking about a more inclusive society as well. Yellen wrote about this an awful lot. And so I do believe that the Fed, as we talked about inflation, is going to look cyclical inflation in the eyes and be slow to respond. I believe some of the response function there is encoded in the belief that some inflation is necessary to have a more inclusive outcome, and a more inclusive outcome, as opposed to less wealth inequality, is a more durable outcome. I think the whole world, from Brexit, is about that, from the right versus left, red state, blue state, from Chile to Hong Kong. This wealth inequality is resonating globally. Some inflation will likely be tolerated to suppress that, and that is new. And that's what you could get a little bit of a tailwind into more structural inflation longer term. But today, anything towards recovery, anything towards infrastructure, we believe the markets will say that is fine.
Degas, question that pops out of that for me. So Matt just talked about, the difference between recovery and stimulus. Does it feel like that in a more polarized nation, which it feels like we have become lately, that it gets harder and harder to define the line between recovery and stimulus, that potentially people are faster on the draw, the markets are faster on the draw to determine that than potentially just looking at the data?
Yeah, Heather, one of the things, and I think this is a very good question, because what occurred January the 7th, 6th, that is actually a result of the wealth inequality, because you have a large part of the United States that felt that they've been left behind. And obviously that's something that we have to admit, that the gap there impacts, regardless of color, it impacts, our country. And so we have to now move through it. And Matt, you made a real good point here. How do we get the right fiscal policy in place? As Sammy talked about this, we have to pass this fiscal policy to start healing the country. And I think that's evident, because if we don't, globally, you're going to have a further separation, a further division between the have and the have-nots. And that, as we are investors, we have to be mindful of that as we advise our clients on how we, through our investments, through our positioning of capital, through that net worthwhile position, how do we get there?
That's really, really great. It's a fantastic moment to just kind of sit down and say, okay, it really feels like we're sitting on the fulcrum, right? It really feels like the decisions that are made in probably the shorter term are going to be very impactful, not only for our GDP, but also for global GDP and how we either come out of this well or don't. So talk to me a little bit about, what does all of this mean ultimately for the 60-40? And Degas, I'm going to go back to you as our equity expert. We've had a great ride, right, with the 60-40. We've had fantastic markets, which at some point I do want to come back to the surprise of returns that we've had. I always like to know what's behind surprises, but talk to me about, here we go. We're going forward. We know we're sitting on a fulcrum. We know that we have to make some real changes in this wealth gap to drive better GDP, and we have to do it globally, right, to bring everyone along. What does that mean tangibly for how the professionals are positioning portfolios right now, specifically the 60-40?
Yeah, Heather, as it relates to 60-40, if you think about 60-40 it really came about when we had the fixed income providing yields 5 to 6%.
Sure.
We're at a place now where you have the 10-year forecasted to be about 1.6, 1.7, to include the yield and the capital appreciation. So you're looking at, say, 1.6%. Now, inflation is right around 2.0. So net, you're losing in real return, you're at a negative 0.5. So you really can depend on the fixed income component to provide that 60-40, that 40% of that 60-40 equation. And what we're seeing is that you're actually losing real return by having that exposure to fixed income. So what this does is it pushes people out further on the risk curve. You're either going to get into the high yield debt to pick up more yield, or another solution would be to look at quality dividend, quality stocks that pay a dividend.
Yep.
But that's pushing out still for our clients a little bit further on the risk scale. So what we see is that you have to start now using that quality dividend, and you can do quality US dividend, you can do international ADR dividend strategies to provide that yield, because if you really can't depend on the 60-40 to provide it as it had in the past.
Mm-hmm. Thank you. Matt, talk to us about fixed income. Does all of this hurt your feelings? Does it hurt your feelings that fixed when Degas talks about fixed income? Matt, you're on mute. There you go. Does it just hurt a little bit?
No, fixed income investors have no feeling, feel no pain. No, so look, fixed income markets have provided incredible returns over many decades, and you've been I think the way to frame this is you've been in a global disinflationary cycle driven by globalization. That globalization has actually created some of the income inequality. Overall, the world is much wealthier, and most countries are most wealthier. It's the income division and the wealth division within each country that has been strained. But the world has created a lot of wealth. The job of global politicians who aren't particularly effective over the last 100 years, is to help manage that so that you don't get such discord that it rips itself apart. And so where you're at the crossroads where the business world needs to help solve this, or the governments will try to help solve this. And generally you want to have at a minimum a partnership there, nothing too prescriptive. The right way forward and the only way forward is to issue the appropriate amount of debt now to provide productivity, but to see a gradual increase in bond yields. There is no sustainable path where you're going to have 3+% growth where you stay at a 1% or 1.1% today 10-year treasury, because the problem with that is you've already had fiscal expansion, the debt load is big, it can go bigger, but as it goes bigger your long-term growth assumptions fall, and you have nearly zero policy accommodation. So you're going to be flying near zero to where the Fed can't cut and the debate will be negative rates, which is effectively a wealth tax, if you were to hit a speed bump in the next 3 years. That is not an environment where corporations want to invest aggressively. They want to financial engineer aggressively in that environment. So the only path forward is to sustain an increase in inflation and a slow increase in yields over multiple years. And that's what was happening post-financial crisis. When people said, we're going back to 4 immediately, we didn't really think it could happen. So as a bond investor, we can't live in denial that the best way forward is actually to see higher yields. But as that happens, yes, your return potential in high quality fixed income right now really does feel like 1 to 3%. And higher risk fixed income, maybe you're in a 2 to 5% range. That's not a lot, but the mistake in fixed income is to believe that you need to achieve something more than that and actually lose the relatively low income that you're trying to attain. So it's okay when real rates are negative to have a lower income return. It's all about your portfolio volatility. But yes, suppressed returns going forward. Look for signs of excess debt growth or financial bubbles or misappropriation like the housing bubble. The good news was heading into COVID, when everything was pulled back, there wasn't a whole lot of inequilibrium as far as debt in the US economy. It was COVID that killed this. It didn't die of old age, right? So the US economy was in a pretty good spot. You just can't expect a massive rebounding growth.
So Matt, I'm going to ask you another question, and then I'm going to take it to Sammy. In this type of environment, you've got probably several years before these rates start to recover. Where are you going to find yield? Are you going global? Are you going to where Sammy is to find yield in this environment?
Yeah, absolutely. I referenced it earlier. Emerging markets have naturally higher growth rates typically. In a highly levered world, you want a higher natural growth rate and you want productive investment. And so I think you're going to see capital move to the emerging markets. That trade started this year. That will continue for some years to come. You also want to look where yesterday's problems are tomorrow's opportunities. So it's very easy to be concerned about portions of the commercial real estate market. Well, that's also known as opportunity to underwrite yesterday into tomorrow. And global bond markets more broadly will continue to grow. Emerging market corporate debt, for example, as you see a broadening the liquidity base there and the investor base there, that's a real opportunity. Broadly speaking, the opportunity for equities to inflate feels like the better upside. But in fixed income, there's opportunities. But again, the mistake is to go too far, to risk too far, because at a low yield, still low interest rate environment, and you've already got fiscal in. If something goes wrong, you need to protect that downside. So yes, there's opportunities, but don't make your mistakes in fixed income. You can't afford to. You can afford that in the equity portfolio where you've already have some volatility where winners can offset losers.
Thank you. Sammy, talk to us about where in emerging markets you're going to find that yield.
Yeah, I'm happy Matt is optimistic. I am too. It's rare to find optimistic bond investors, so much even more rare to find two of us. We're known for walking down the street on a sunny day looking at the cracks in the sidewalk as bond folks. But here we are, and I'll say a few optimistic things. So one is it's not over yet with duration. The 30 years around 2%, there's still a 20% return in that thing if there was a financial market shock. So let's not call it dead yet. Second, when you're in a period of financial repression, the historic volatility of higher yielding debt gets deflated. And look no further than Europe. The European high yield market spent 80% of the post-Eurozone crisis period under a 3% yield in double Bs. I mean, certainly the rubber band will snap the other way if something goes wrong, but it does deflate some of the trending volatility in that market. So for us, I mean, the financial repression is the best thing that ever happened to me as a EM debt manager, right? It's taken more eyes over to us. And our industry, our asset class is very simply about compound interest. My wife teaches high school math in Baltimore City. She has a financial markets section of her course. I have nothing better to do, so I helped her write it. She teaches those young girls in Baltimore City, it's an all-girls school, about compounding interest. And I actually think those young women would be better investors than many professionals because it's the only principle they know, and it's one of the most powerful ones in global finance. Since 1993, you can't go back further in emerging market debt, the asset class, despite its horrible label, emerging market debt, has earned a return of 887% cumulative. That's 8.8% a year just at the index level. Forget excess return. It's actually almost more than double the return on emerging market equity. You can't compound an equity, particularly one that's in foreign currency. Whereas a hard currency debt in the US dollar, you can compound that over time and it ends up being pretty powerful. Now, I'm sorry to say 9% returns are gone, but the real return, or that return above treasuries, is unchanged. That's your spread component. It's actually relatively fair to history. I can't do anything about duration being largely exhausted, but the return above the risk-free rate is still available. And unlike the 1990s or the 2000s, I think the period that informs most of us and many of our perspectives on emerging markets, the historic volatility, not just of the asset class, but also of the countries, has deflated. I talked about my colleagues in Asia are already back in the office. It's a twin surplus part of the world that actually knows how to manage a pandemic. I've rare to find you a better story than that. So I think you can compound interest in emerging markets today more readily because there are other tools available to you. Countries that are running surpluses, not just the 1990s group that was very commodity heavy. And lastly, I would just close on, even if duration were exhausted, there are also total return strategies and total return techniques in portfolio management that we can use to use other financial market assets to hedge out left tail events.
That's awesome. Thank you. Brian, talk to me a little bit about alternatives. Talk to me a little bit about the different space. Can we go there?
Sure. So alternatives have become quite mainstream. It's almost like, the rock station that I listened to when I was in high school is the alternative rock, and now it's classical, right? So, or it's the classics channel, I think, is what they're playing some of that stuff on now. But as Sammy pointed out, the importance of compound interest. I think it was Einstein who allegedly said that it's like the eighth wonder of the world. It's the most powerful force in the universe, that he who understands it earns it, he who doesn't pays it, right? And when it comes to thinking about like a 60-40 portfolio, and then the role of alternatives within there, where do you take it from? Which is it, from the 60 or is it the 40? And the fact is, the 60-40 portfolio isn't dead. And in fact, I think that you're probably 5 years from now, you'll look back and be like, oh, 60-40 actually didn't do all that badly, mainly because if you think about it won't likely do as well as if it was more tactically oriented or incorporating like long short strategies and such. But if you think about the role of bonds in general in a portfolio, right, it's to provide income. There's not a lot out there right now, unless you're in Sammy's space, right, looking at emerging markets, or I'm sure, Matt, looking in high yield space. So you have to take on some of that credit risk. So there is some income, just if you set your bar a little bit lower as far as 2% inflation, right? You want to clear that. It's a little bit easier to find at least some places, but there's not a lot of that income. But then the other role of bonds is to provide the diversification to the equity risks. And there are periods of time where the correlations can change. Now, I highly doubt that you're going to have a situation where the correlation goes to 1 between the equities and a broadly diversified bond portfolio. Maybe if it's high yield, right, you can see those correlations get close to 1 in a crisis type situation. So it'll probably still play an important role as far as some sort of ballast or diversifying role. But if instead of thinking of like a government bond as a Swiss Army knife where it can just do everything for you, providing the income and the diversification, maybe you need to use more unitaskers, right? It's like, okay, what are you going to do for the income? We can use EM debt, we can use high yield, some lower quality investment grade. Maybe you can look at real estate investment trusts, MLPs, et cetera. But then the diversification part, if it's for that risk management, Sammy alluded to some of the tools that they're able to use from a total return perspective. Think about dynamic risk hedging, downside risk management, using of various option strategies. I think if we enter into this period where rates begin to rise, whether it's fast or slow or what have you, that's probably going to be playing a more important role. So maybe you don't have to change the 60-40, you just have to change the composition within the 60 and within the 40 to hit any income target that you might have, and then to have a wrapper around it as far as providing some of that downside risk management. So I think that's probably the role of like alternatives. So instead of just cobbling in an alternative like a hedge fund strategy, it's more about looking at it holistically from that portfolio. What's the objective? What's the goal? What's the problem you're trying to solve for? And then wrapping it with some sort of, with derivatives or, some type of other more alternative like strategy.
Thank you. Matt, I'm going to ask you real quick something that just popped in my brain. Talk to me about annuities. What do you think about those? What do you see as, do they make a good substitute during this time?
I think existing annuities can make sense for a financial plan. I actually think what you might see developing over time is deferred annuities. So you invest for your near term, and boy, you want certainty from 70 plus. I think the market right now for annuitization immediate, it's difficult because of the fee base which is needed to provide the product. So not against annuities as a part of a financial plan to provide that stability, but difficult in a low yield environment. Lifetime income difficult in a low yield environment. The central banks around the world are basically saying the price of certainty is extremely high, and that's so not against annuities, but just know the whole world, like this growth stock phenomenon. Things are crowding into anything that looks like it has its own growth because there's still insecurity about the longer term. And central banks are trying to force all this huge amount of money into these smaller risk categories. So annuities, unfortunately, gets trapped in that. It's not necessarily bad. Just know the return is going to be relatively low.
Sure. Thank you. I think that kind of broadens into my bigger question around, it's times like these that innovation really matters, right? Like people start to think about solutions and new things start to pop up. What is the next innovation in this space that either it's been there for a while, it just hadn't gotten a whole lot of traction, or it is completely unseen at this time and something that's going to hit this market and be a player for the next 5 to 10 years. Degas, we're going to start with you.
Yeah, so Heather, one of the things we have to look at is what's happening generationally, and this is also a global issue, is the Millennial Generation. And so follow right behind with the Z generation. So what happens with the Millennial Generation now is that they are coming into and they're starting households. So that is a major wave, and that's pushing innovation. You also look at what's referred to as artificial intelligence, the Internet of Everything. And so you have not only a generation, and millennials are from 25 to 40. And so starting households, they have the use of Internet of Everything, artificial intelligence, that's impacting and making an impact throughout all our industries. Lastly is the sustainability. The discussion around the environment, discussion around societal things that we need to do in our society, and then corporate governance. Those are the things that are driving innovation, driving the disruption. And what we really look at is that we build our whole outlook, because as investors, we're bottom-up investors, but it's important to have a macro trend. And we feel that in the US and also globally, those are the three trends that we see really impacting innovation going forward.
Thank you. Sammy.
Yeah, I would further that point and say there is an absolute ESG integration tsunami, avalanche, whatever you want to call it, that already is here for my European, my Australian client base. It is the #1 driver of my RFP content outside of the United States. Our clients, as they should, are holding us to a very high standard. I need to report the carbon footprint of my portfolio, the social impact of our investments in detail down to the holdings level. We have not seen that yet in the US, but it is coming. I just want to underscore, and if your portfolio is not already ESG integrated, you're already behind the curve, because pretty soon it's going to come as responsible investing, where you're having to balance both the return and the impact side.
Awesome. Thank you, Brian.
Yeah, a lot of our clients, it's just table stakes. If you don't have ESG, you're not at the table, right? You need it, and that's coming to the United States, and it's growing, and it's probably going to, happen a lot faster than what a lot of people are prepared for. And really, it's for us looking at having that whole sustainability platform, right? Have it integrated into the security selection, have it integrated into the way in which you engage with managers in the securities that you invest on behalf of clients, the way that you vote them, right? So that stewardship component, but then also the way in which you do the asset allocation as well. It's just, it's a little easy to think about, oh, well, if I want to improve the ESG score of this overall portfolio, I'll take a highly rated fixed income and highly rated equity and cobble those together. But it's like, these things kind of interact, right? You got to take into consideration the correlations and the covariances, because you can actually end up with, or if you don't take a thoughtful approach to building the portfolio from that asset allocation perspective, you can really miss the mark. You might hit the ESG goal, but what about the financial goal? Right. And we've done a lot of research on that, as far as what effects will like climate change have on different asset classes? What effect does it have as far as with the dispersion of returns and correlations depending upon the ESG rating within different sectors of the equity and the fixed income market? So taking that very holistic, integrated approach is probably the next frontier. And how can we bring that to the masses then, right? Where it's not just a niche product, something that's just for institutions. And I think this feeds into kind of the other innovation, which is bringing like SMAs to the masses. You're already seeing it with like direct indexing, right? How can you bring it to a lower price point? How can you bring it to maybe a lower amount of AUM, as far as a broader swath of the population to benefit from these more sophisticated techniques? So those are some of the areas that I think are probably over the next year or two, you'll see a lot of innovation around that, both the ESG integration with asset allocation, and then more of the mass customization of things like SMAs and direct indexing.
I love that you talk about direct indexing. That's exactly what was in my mind of Sammy. I think it's interesting that you mentioned that, the sustainability hasn't really gotten to the US yet, but it is full force globally. And it's kind of like, why are we so far behind? Why is that not the case? And then, direct indexing, how do we get it all ties in my brain. How do we get these solutions down to the masses with the same feel of customization that the high net worth individuals can have? And what pops in my brain is this feeling over, I think indicated with GameStop over the last 2 weeks, that the system is rigged. And I kind of take that back to this wealth gap of, it's really only accessible by a certain type of individual. And how do we make that accessible to everyone so that everyone can get the benefit, Sammy, to your point of the compounding interest? But is it rigged, right? So there's that. Matt, talk a little bit about what we saw in the last week, what we've seen with, the FANG stocks and the IPOs and the SPACs and the real speculative nature of parts of the market right now, and what do we do about it?
Right, so it's a big question. There's a lot of elements in there. I'd say first and foremost, it reminds us there's a lot of capital in play, and so targeted relief is really useful. More stimulus in some ways is particularly not useful. So I think the markets want some differentiation between that. Two is the American ideal is equality of access. It doesn't mean you have equality of tools and access. So I think the argument that you can day trade is fine. And I think that in America, the social construct is put the individual investor in a place where they're going to need advice, they're going to need help, they're going to need some component of savings. But I'm not convinced it all goes into institutions. Some component's going to be in their hand and their smartphone. And I think so. What it means is we're going to need to arm those investors, and we're going to need to invest in high school and in college in financial literacy, because there is a desire to democratize it more. I'm not sure that it's fair to believe that most people don't have access. They're just not sure they trust the access they have. And those are very different things. But I think that in the end, what you're going to have is a need for financial literacy, a need for guidance, and an exception, in accepting that you can play this game, but there's big firms and billions of dollars and quants that you're playing against, and it's still okay to buy individual stocks. But I think the other big trend in the U.S. is that's going to go global. We've never had to export capital in the U.S. So it's not just in Atlanta, do you like Coke better than Delta, better than Home Depot, better than UPS, right? It is, what are you thinking about doing with the yen tonight on your option trade? That's in the hand of individual investors today. And so I think what you're going to see is a bifurcation. I think you'll still see what can look like speculative, but it's okay. It's their money. And I think there's going to be a safe pot of money, which is going to really need professional advice and guidance. And that'll be their stable pillar. And I think you're going to see a bimodal world a bit in that regard. But there is access, in our opinion. There just might not be trust. And look, that's the job for the investment world, representing savers or investors and banks, to further the message that CFAs aren't there to try to rip you off, right? We're there to try to provide professional access in the best way. And it's okay if you have your own opinions, you want to deploy that too.
I love that. Thank you. Degas, what are your thoughts on where we are right now and what Matt just had to say?
Yeah, and I agree with Matt. You know, financial literacy, it really needs to be taught in the school to really get young people prepared for the opportunities. And to his point, what happened with GameStop and other, that's really more about sentiment. And we as investors, we have to now know how to measure sentiment, because that was definitely a driving, it wasn't tied to fundamentals, but as a market structure, we understand what occurred. And so that's the role of us as investors. We have to be able to explain that to our clients, because we probably all have gotten that question, what is up with this GameStop? But we're able to explain it, but it still means that things will happen. And I really look at, you know, is this a bubble because we had GameStop? It's not a bubble. It's one stock that, because of structural issues, was able to run significantly higher. But it's not a bubble, because we have to look at the overall market. And that overall market, where we are right now, and we compare it to 2000, which is really the last major bubble that we saw that the earnings yield back then was what, 4%? Bond yields were almost 7%. Today we have the earnings yield around 2 to 3, almost 3. Our bond yields are closer to 1. So we're not in that bubble stage yet for the general market.
Thank you. We've got a couple questions coming in, gentlemen. So let's just take these one by one. Can small and mid-sized firms compete in ESG given the demand for additional research? Sammy.
Yeah, I think they certainly can compete. I think what clients don't want, however, is just to see you have a checklist that you look at a stock or a bond and then you go through E, S, and G. They actually want to see some philosophy of how you integrate it, why you think that's important. I don't think it takes 100 people to do that. So I do think a small and medium-sized firm can compete, but they need to compete on the IP, not on the number of people involved in it.
All right, thank you. Degas, I got one for you. Is the financial payoff for fiscal support of physical infrastructure greater than, equivalent to, or less than investment in human capital? Or is it a timing issue?
Oh, great question. I think what we have you break that down, what's easier to do? The easier investment is the physical capital.
Mm.
Because, you know, we could do an infrastructure bill this year, and that can have an immediate impact on the economy. The longer investment, but the more investment that has a longer staying power, is that investment in the human capital.
Mm-hmm.
And so as investors, we all say that we're long-term investors. So I would say the investment in that human capital really makes a difference.
Wonderful. Brian, outlook for the US dollar.
It'll go up and it'll go down. Yeah. So, it reminds me of this joke from economists where it's like, you know, it's all relative, right? So it's like, you know, how's your wife doing? Well, compared to what, right? As far as the dollar, compared to what? Compared to the yen, compared to the Swiss franc, compared to the euro, compared to the emerging market currencies. The way that we're looking at positioning portfolios is that we've had, DXY is just a broad measure of the dollar. It's imperfect, but you've seen a lot of weakness. We've seen a bit of a bounce here. That is dominated by developed market currencies relative to, say, the pound and to the euro. You know, when you get into the U.S. growth picture, as far as growth as being a driver of the value of the dollar, relative growth rates, because it is all relative, right? U.S. growth is likely to be better than what we're going to see coming out of Europe. Likely out of Japan, maybe on par. The UK will probably lag a little bit, but so we're thinking that just that growth picture, you're probably going to see the dollar strengthen relative to maybe the major currencies, but against the EM, you know, Samuel knows more about those EM currencies. I mean, it's a basket case of currencies, but broadly as a group, we think that the dollar is likely to depreciate relative to most emerging market currencies because of that growth differential.
Awesome. Thank you. Sammy, we've got one for you. Sammy commented about China aspiring to reserve currency status. Is there a threat from Bitcoin to reserve currencies?
That is a fantastic question. So no, let's let it get regulated first. I think before we make a determination on the long-term future. I think when we're talking about money, it's important to recognize that many things can be money. In financial markets history, cows, seashells, stones, copper, silver, gold. The Italians at one point had cheese as money, which is, I think, fantastic. So lots of things can be money, but money needs to serve a certain purpose. It needs to be either a unit of account, a means of exchange, or a store of value. Ideally, all three of those things is what makes a powerful currency. And I think it's that last piece, that store of value, that Bitcoin is lacking. When you put your money in a CD and you're earning maybe nothing, at least you know it's there. Whereas the volatility on Bitcoin, certainly that volatility has worked for you that have been in the trade early, but that type of volatility prevents it from actually being money. So if you want to own it, Godspeed, but don't own it as you would cash or expect it to function as such. I'd rather just put that into Parmesan cheese.
Yeah, if I could follow up on that, I'd argue that Bitcoin doesn't satisfy. It's neither a bit nor a coin, right? I mean, I think it's many more bits than just one, and it doesn't serve as a medium of exchange except for a small subset of the population. Very useful in hyperinflationary economies, failed states, as far as, you know, the satoshis and that are traded, that because people don't trust their governments there, right? And people would rather have the volatility of the price than the volatility of the inflation if they do use the domestic currency. So very limited use as far as a medium of exchange. Unit of account, could you imagine using it to, if you were going to go buy something? I go to Target all the time, right? And all of a sudden that thing of milk, if it's the price fluctuates in the span of when I'm waiting there in line, you know, by about 10 to 15%, that'd be a little unsettling. So it does need to a lot more maturing before it could serve those roles. The way I think about it is that it's more like a collectible, right? So it's not a currency, it's not a commodity, it's more like a collectible because it's driven by the tastes and preferences of certain groups of individuals. And so maybe it's like a Monet with, a blockchain technology attached to it for transfer of ownership.
Yeah, maybe build on that. I love that analogy, Brian. Maybe it's like a stamp portfolio. And also in a zero interest rate world, the opportunity or negative, the opportunity cost to own Bitcoin is zero. If and when you have a interest rate component at play, there's a real cost. So it's easy to inflate in this environment. And that zero interest rate environment actually makes people concerned about the fiscal stability. And are we overjuicing the economy? So I think you could view Bitcoin as another way to view it as a gauge of financial distrust in the global system, which is terrible because we want the globe to have trust in the financial system, and it's the ideas and it's the productivity and it's ingenuity that's going to drive real growth. So I think there's a lot of different ways to view it, but unlikely that government through the main banking system is going to let it usurp it when it defines the capital rules.
Sure, thank you. Matt, I'm gonna stick with you. Will deficits ever matter for bond markets or equity valuations?
They will, and again, I think that's the key. Right now, it's the difference between supporting and building back from a drawdown versus overstimulating on the upside. So I think investment in education, investment in infrastructure, things that are productive, left side of the balance, the asset side of the balance sheet matters too. If and when you get beyond that, it will matter for markets. You'll see both bond markets and equity markets actually push back.
Brian, should commodities be the new risk-free asset?
No, because if you think of a commodity, it's commodious, right? I mean, it's useful for other purposes. And so I have a hard time getting excited much about commodities themselves. I mean, we do trade in commodities as far as with the futures, as far as, there's rather consistent evidence as far as the value of investing in those things that are in backwardation, right? But over the long term, most of the return on a commodity portfolio isn't from the change in the spot price. It's actually from the value of the collateral that you post for the futures contract, which is treasury bills usually. So as far as a risk-free asset, it depends on what you mean by risk, right? Free of credit risk. Well, there's very few options besides certain money in the bank and with the government with treasury bills. Now, if you're talking about risk-free as far as free of volatility, good luck. Right. I mean, maybe cash, but then if you measure it in inflation adjusted terms, there's risk there as well. So you can't get away from risk. So I say credit risk free, treasury bills, but nothing is really risk free.
Yeah. Sammy, are there any countries that you are watching as an early indicator for vaccine impact in the US?
Yeah, so I think all eyes are on Israel. So a small, wealthy country that can actually vaccinate very quickly. And there's some really encouraging signs there. I think the problem is not every country has the resources of Israel. So they're well beyond 20% vaccination rates. The UAE is up there as well. The US is hovering around 10%. And then I think for the rest of EM, it's all eyes on Chile. They just rolled out last week. They're at, I think, 4% now, but it's parabolic in terms of how quickly it's gone out. Unfortunately, EM is going to take a lot longer to vaccinate. So I think for us, it's looking at the emerging market countries that benefit from DM vaccination. So think about the Bahamas. Once Americans are vaccinated, they are going to go to the beach as quickly as they can. So they're going to benefit a lot more quickly than, say, India, which sadly is probably going to end up going a herd immunity route, if that's even possible with the virology.
Okay, I do want to remind everybody that you can enter your questions there's a window on your screen that you can enter your questions and they come through here. So please don't hold back if you've got anything. Matt, what are your projections and thoughts for inflation?
Yeah, so we're still in the cyclical versus structural camp, and so but you need to get through cyclical before it becomes structural. And policy can help push in that regard. Every incremental sign we're seeing as far as chip shortage, minimum wage push, and administration push generally is towards let's push inflation up, and that is likely to correlate with a more inclusive outcome. The other thing I'd say, when you look at the TIPS market, and I mentioned this earlier, a little over 2% on the 10-year TIP. Investors are willing to accept a negative 1% real return on the 10-year TIP right now to receive inflation. I think the best way to view that is, yes, there's financial suppression, as was mentioned earlier. There's also inflation uncertainty. So if an investor has a desire just to reduce their uncertainty, say, just pay me inflation. I just want to keep relative wealth. There's a lot of demand for that right now. So that's keeping real rates relatively lower. People will pay 1% below inflation just to receive it right now. But if inflation were to be 5, 6, 7%, paying that one doesn't sound so bad. So the markets don't believe in structural inflation. I also think the markets are telling you there's gap risk or uncertainty risk. So our view is you'll create cyclical. Structural, it's unlikely still. The big wild card is we think disinflationary forces globally exported from emerging markets and developed markets is starting to ebb, but that should be a multi-decade path. If you see, and Samuel will see it first, consumption out of EM really growing to replace Western world, I think that could do it. So look for EM to actually be one of the speedometers for inflation over the next decade. But again, it's going to take some time, in our opinion.
Wonderful. Thank you. Brian, Yellen is the first Treasury Secretary to not have Wall Street experience in 3 to 4 presidents. Are there things an economist might pursue that a Wall Street person would avoid, and vice versa?
That's a good question. I don't know if she doesn't have Wall Street experience giving the speeches that she's given, right? I mean, what do we mean by Wall Street experience, really? I guess technically I don't. I've been to Wall Street, but I'm in Milwaukee, right? So, with her background as an economist, I think is very important, though, because of her focus. She's been very much a consensus builder when she was at the Federal Reserve, and I think that's what she's going to try to do within the Treasury, work with Congress as well. So very well respected. She definitely has the academic credentials to persuade people, and apparently she also has the personality to do it. So I think she's going to be a very powerful force.
Wonderful. Degas, talk about how you see the future of the industry with increased digitalization.
Yeah, so with that, and that's going across all our platforms. And so it makes data information easier for the individual investor to use. And Matt talked about this. So as investors, as professional investors, how will we serve the client now, given that they have as much information as we have?
Mm-hmm.
And so we then have to look at the value add of our services to what they can do at home, sitting in front of their computer. And I think that really will start distinguishing investors in our industry from what's the value add. And I'll go back to looking at environmental social governance, in that now we can maybe assist those clients to look at that lens of how can we incorporate the corporate social responsibility reporting into stock selection. And that's where we can have that value add. So I think that's where we see the difference now. Digitalization, our clients are sitting at home with maybe even better tools than we have.
Mm-hmm.
So how do we add value?
It's kind of like WebMD, right? You always Google your symptoms before you ever actually go to the doctor, and then you tell the doctor what's wrong with you.
Right. Exactly.
Okay, so I've got a question for you, and then I've got a great question that kind of segues into our one of our lightning rounds at the end. But one thing we haven't talked about yet is energy. Brian, I think at one point when we were talking about alternatives, you mentioned MLPs. Talk about energy. What is going on with energy, and what is the outlook here? What is the path forward for energy right now?
Well, yeah, and energy is a broad group, and it's going to grow as far as the types of sources of energy, right? And you've already seen that from different corporate announcements as far as the greening of the energy sector. And so I think that's one of the kind of exciting things about it, is that we need energy in order to produce and to live. It's just, can we do it in a way that isn't so harmful for the environment, right? And it is going to be probably a longer transition, but we're making some pretty good progress on that front. I'd also point out that if you look at the actual like the oil content of GDP, and this is some data that you can get from the Bureau of Economic Analysis. They've looked at that as far as the amount of oil that we use to produce, $1 of GDP. It's been on a steady decline since the 1980s, from the
Mhm.
oil price spikes that we saw in the early 1970s. A lot of this is with efficiency. I mean, I'm kind of a firm believer that capitalism is the enemy of waste, because anything that if you can do something more efficiently, if there's waste, let's turn it into something that's maybe profitable and not wasteful. So energy, I think, is an area that's really interesting, but maybe you do have to be a little bit careful about what sorts of investments are they making in terms of legacy systems versus some of the newer systems. So
Mhm.
there are some, a lot of really good dividend paying stocks within the energy space, but something to kind of consider when you're looking at some of that security selection is more what's the investment plan going forward.
Mhm. Mhm. Degas, you agree?
Yeah, I agree exactly, because one of the things, and here's something that is also a global impact, in that the emerging markets, they require, or they're trying to increase their electricity. And right now, fossil fuels is the most efficient way of delivering greater electricity to those emerging markets. So now we have to look at the transition plans. To Brian's point, what is that fossil fuel company? What is their plan to transition? And so when we look at an energy company, we're looking at a transition plan.
Mhm.
And there's some companies out there are doing that very well. As Brian indicated, there's also additional players now, or entries that are coming into the market from solar, wind, and so we're seeing that, obviously the batteries. So all that's coming to play. So it's really expanding that energy market.
Mhm. Sammy, what are you seeing globally regarding energy?
Yeah, so I'll say near term and then long term. So very near term, oil tends to snap like a rubber band on either side, and the inverse of negative oil, whatever that demand supply shock was last year, is not where we are today. So we could easily overshoot in the back half of the year as demand comes back. Right, we're all going to be back in our cars, driving, visiting family. Fuel consumption is going to go up. Um, is supply going to come online quick enough to deal with that? And a lot of these wells on the shale side have been capped in. So I think that's the curve is in backwardation, telling you that it's not going to be an issue. I think that could very well be wrong, and actually accelerate the inflation in the back half of the year. So in the first half of the year, we're lapping easy comps on inflation. If oil stays 60 or maybe even overshoots higher, remember, think about the inverse of whatever negative oil was. That could actually lead to some inflationary surprises in the back half of the year. For globally, what that means is some countries have not adapted their economic model yet to what the shale gas revolution did, which is structurally decline the cost of oil. So think about Algeria, Angola, Oman, countries that have like $100 required to break even their fiscal, $85, $90 required to break even their current account, and rising social demands with COVID and Arab Spring and otherwise. It's tough I mean, there's going to be some countries really on the wrong side of this. South Africa is another one I would mention, expanding the energy matrix into coal, where you have a 10-turn levered monopoly utility provider that's almost all coal powered,
Mhm.
and they just simply don't have the money to fix it. So I think there's a few countries I'm quite worried about on the other side of this.
Thank you. All right, we've got about 8 minutes left, and we are going to go to our lightning round. You each get 2 minutes, and then we will hand it back over to you, Aaron. Each of you tell us, you got 2 minutes, or you can do it in 30 seconds, whichever one suits you best. I'm buying. We want to know, what are your best ideas in each of your sectors? Brian, we're going to start with you.
Oh, good. Yeah, well, as a multi-asset class strategist, I get to cover everything, I guess. So I'll just tell you about where we're positioning
Yep.
portfolios based upon our outlook. And, we are pro risk on. Right now, we are favoring small over large. We think that over, the last 5 years, small has underperformed large quite significantly. Value has underperformed growth. And so maybe you could see a little bit of a rotation. Some of the more academic related work that we've done has shown that small and value tend to do best when you have a pickup of inflation uncertainty. And we think that we're going to have inflation uncertainty for quite a while for the balance of this year. And so that inflation uncertainty could resurrect the small cap premium and the value premium just after everybody has sort of left it for dead. And now we also like emerging markets over developed markets, mainly because of the better growth differential that you see there. And fixed income, sorry, Matt, and sorry, Sammy. Well, not so much Sammy, because I mean, we do like EM debt, but it's just so difficult to get excited about fixed income. It's almost like trying to find, winning who's the cutest dog in an ugly dog contest.
Poor Matt. Matt, we're going to go to you just because I feel sorry for you at the
I need to
moment.
defend myself. Yes, no. Look, it's fair. Real rates are our challenge. Brian is absolutely accurate. I think the key is, again, there's two things to guide you. You still have to protect downside in fixed income. There's only so much money to be made. Where there are opportunities, and we referenced a few, emerging market debt over time makes a lot of sense. We think that you'll see a more globally oriented base of growth as you spin through the next 2 years. Western world will actually likely hit a growth wall sooner than the emerging world. It is very likely. So it'll be choppier, but don't run away from that. I mentioned commercial real estate earlier. Really important that, I like to think about monetary policy as being ibuprofen. It kills pain and buys time. And that's really useful. And we've seen that over time. Fiscal is like a steroid. Fiscal is finding ways into GameStop. It's finding ways into growth versus value. That money that looks at the equity market and says, boy, it doesn't look cheap, but earnings, as we've talked about, look pretty good, is also going to look at every other cheap asset in the world. So right now, the abundance of money will find a way to make an incremental mall or old AMC theater or something useful of it. So you've got time and you've got money. I like to bet on the US economy with time and money. So look for assets that have fallen below the radar screen. You've got the two main ingredients to create surprise, and entrepreneurs will make that happen. So distressed debt opportunities, out of love bonds, either in emerging markets or tied to US assets. Look for those to surprise to the upside. So again, Brian, not a beautiful array of puppies, but there should be enough to make it howl a bit.
Matt, that was pretty good optimism coming out of the ugly dog contest. So good job. Proud of you. Sammy, talk to us about the emerging markets. Where are you going?
Yeah, I'll be brief. So obviously the areas of compound interest, so emerging market bonds, global high yield bonds, throw in inflation linkers with a 1-year view, US value stocks. We haven't talked about that yet, but I would throw that in there if the inflationary thesis turns out. And lastly, and this is really just because of my audience and the hole I dug myself into because of the Falcons pun, but I will say call options on the Atlanta Braves, because I think their future is very bright, and the Marcell Ozuna signing was golden.
Way to dig it out there at the last, Sammy. All right, Degas. Oh, Matt's got something. All right, Degas, I think this is my last chance to ask you to bring it home for us. What are you buying?
Right there. So I own all these stocks that I'm going to talk about. So one, I will go back to the millennial purchasing power, the Internet of Everything, and ESG. Example, one will be Etsy, because one is that it allows you to sell products from your home. 90% of the vendors on Etsy are in their home. Second thing about Etsy is that 80% of the entrepreneurs are women. So it's a really good company. And if you're going to pay for your Etsy order, you're probably going to use PayPal. PayPal is doing outstanding. It gets into the millennial push there. It actually gained over 60 million subscribers faster in the last 10 years. In 10 years, it took JP Morgan 30 years to get to 60 users, and they had to go through 5 acquisitions. So Etsy, PayPal. The gaming would be NVIDIA. NVIDIA has GeForce chip that is doing a lot of great things on all your platforms. You can use a GeForce chip. Also, NVIDIA actually owns green data centers using AI. And lastly, the ESG, There's an engineering company that's working with the 100 cities, 100 cities resilient project, ACOM. Outstanding engineering company focused on sustainability.
Gentlemen, we are at 4:59. We are right on time. It has been an enormous pleasure. Thank you so much for your time this afternoon. I hope that the audience that I can't see right now got as much out of it as I did. It has been an honor. So thank you so very much. And Aaron, take it away. It is your turn.
Thank you, Heather. That concludes our program this afternoon. I'd like to extend a special thanks to our distinguished panelists and moderator of today's event, as well as our corporate sponsors, Voya Investment Management, T. Rowe Price, and Wells Fargo Asset Management. We appreciate all of our members and guests for connecting with us today. And please be on the lookout for an event survey and webinar replay to arrive in your inbox. Thank you.